Previously on Stay in Your Lane.
We're starting to see, or have been seeing, a slowing economy and cooling inflation. And that's not a surprise. That's what the Federal Reserve has been trying to do over the past couple of years by raising interest rates. Now they're at the point where they see inflation has started to drop off much more towards where they want to be. So that's towards one of their goals. The other goal being employment. Let's just call that economic activity again, because employment is the best, I think, and most important measure of economic activity.
So, if they lower rates, how much do you think is enough to keep the economy from cooling too fast? What do you
Well,
anticipate?
yeah, so we would expect to see two or three times this year, at least two. There's kind of an interesting thinking around November, because the Fed meeting is the day after the presidential election. And no matter who wins, if the Fed cuts interest rates the day after the election, you know, it's going to be seen as they gave favoritism to somebody. So they might skip that one, maybe not, because they want to say, we're independent. But in any event, we're going to see two or three cuts through the end of this year. And then going into next year, you could have four cuts, more than that, maybe six cuts. Um, and a lot of the reason of this is it takes a while for these interest rate cuts to have full effect.
Right.
First of all, the Federal Reserve, like all the other central banks, likes to change policy a little bit at a time. It doesn't want to cut rates by 2% in September. That's too much of a shock to the financial markets and to the economy, especially when everybody is expecting 0.25%, or what we call 25 basis points. So they do it a little bit at a time. And it takes time for each of those hikes to work. Now, if I can do this right, I'm going to do a share screen here, and I'll show you what I mean. Let's say, look at the chart on the left. That black line is that Fed funds interest rate. And this goes back, 40 years now. And the blue line is the 30-year mortgage. Now, if we look through history, where each of these red circles is, going back into the 90s, the Fed cut that black line very dramatically and rapidly. And the 30-year mortgage came down some, not as much. We go back here into the late 90s, 2000s, the Fed cut that black line, that Fed funds interest rate, a lot. And that 30-year mortgage hardly moved at all. Same thing during the Great Recession. Fed cut rates rapidly, very little movement in the mortgage. Some movement here most recently. The point of the chart is, historically, every time the Fed has cut the Fed funds rate, 30-year mortgage just doesn't seem to come down nearly as fast. Well, not a surprise.
No.
Banks determine to a certain extent what the 30-year mortgage is, and that's a price, and prices are sticky, so they don't want to let that price fall too much. So the point is, pardon me for reaching in there. Sorry about that. I had to change chargers. It's about to go out. The point of the chart is, yeah, you can cut the Fed funds interest rate. It's not going to be a giant boost to the housing market right away. Eventually, but not right away. The chart in the middle shows the same thing in manufacturing. So it's the same black line. That black line is the Fed funds interest rate. The blue line is a measure of manufacturing. These vertical dotted lines show when the Fed has started to cut. So you can see right there that the black line has started to go down, represented by the, demarked by the red line. And then the blue is manufacturing. Well, you can see, okay, the Fed cuts here, but there's a lag between when the Fed cuts and when it affects manufacturing.
Yep.
You can
Takes how
see this.
long? 3 to 5 quarters?
Exactly. You're starting to remember all this stuff now. Yeah, something like that.
Three to five
And you can,
quarters before we feel the impact or see the impact. So the Feds make a cut, then they're gonna wait and sit back and watch and see what's the full impact they think before they make a second cut, right?
no, they're probably going to be on a path because usually they have a path in mind. It's not going to be just one. It'll be a
Okay.
series of cuts, knowing that there is going to be a lag, but they're going to have to cut more than just once to reverse the situation of an economy that might be cooling too fast.
Okay.
Same thing, finally, the chart on the right. This is the Fed funds rate versus credit cards rates. We don't have actually much history on credit card rates, the orange line, but you can see the same situation. Fed cuts rate, credit card rates in this case did go down. Fed cuts rates, credit card rates went up. Fed cuts rate, credit card rates about neutral, and now they're at a record high of 21%. And guess what? I think the Fed can cut that Fed funds rate, start cutting it, um, 50, 75 basis points this year and more next year. Card rates are going to be really slow to come down. So here you have three examples. The Fed cutting rates and the 30-year mortgage not going down very fast, manufacturing not recovering very fast, and this source of funding for consumers isn't likely to come down very fast either. So there's that lag you're talking about that's absolutely spot on. So the point is, they're going to have to cut more than once. And this is typically the case. Most central banks, including the Fed, will go several times in a row.
Wow. So where do we go from here, Dan, and what's next?
Well,
Where's the
Fed,
crystal ball?
uh, well, we've been talking a little bit about it. The Fed is going to cut interest rates, which would stimulate the economy, as you noted, over the next 3 to 5 quarters and help continue to keep inflation under check. But we've already seen signs of the economy weakening, and we would expect to see that continuing a little bit more because of all the previous interest rate hikes. Now, Fed cuts rates, and as we just demonstrated, it's going to take a little while for that economy to start strengthening up again.
Okay.
That's kind of what we have in store. We don't think that it's going to be real fast. We expect to see continued slow growth in 2025. Not a recession, but slower than historically,
Okay.
because the Fed has hiked rates, and that lag of cutting rates is going to take a little while. So cutting rates does support the economy. It just takes a while. So we expect next year to be hanging on, but with slow growth.
So more of a transitional year?
Yeah, I think that's right. I mean, where the inflation is starting to come under control pretty well, and growth, while it is cooling, probably has a pretty good chance of reaching close to historical levels. Um, but the charts I just showed you showed one thing, which is that in any policy decision or any decision you make, there's a cost and a benefit. Usually people only want to argue one side. Their side is right. It's the cost or the benefit.
Okay.
So like the Fed has been slowing inflation, and that's good, right? That's the benefit. Well, the cost is they've been slowing inflation but cooling the economy, and that's bad.
Right.
So there's always a trade-off. And anytime there's a policy discussion, you're only going to hear one side from one person. There's no cost benefit analysis. And that also leads even more clearly to fiscal policy. Now, the government has two tools to manage the economy: the monetary policy we just talked about, which is run by the Federal Reserve, and then
Right.
fiscal policy, which is run by Congress and the administration, which is basically taxing and spending. Now, in the post-COVID era, there was a lot of spending. That is, the federal government just flooded the money out into the economy because, we shut the economy down. People have to have money to live, but they spent a lot more than really needed to be. Now, how do they do this? How do you keep spending money that's a lot more than you bring in taxes? Just as sort of a rough example, let's say you bring in $8 in taxes, but you spend $10 trying to stimulate the economy. Well, there's
Where's
a gap
the other
there.
two come from?
Yeah, where's the two come from? Well, one way or another, at some point, it's going to come from the taxpayers. So it's going to be a tax hike now to cover that $2. Or what we're doing instead is borrowing that that $2. And we borrow it from investors all over the world by issuing U.S. Treasury notes and bonds. Very liquid market. Lots of countries and businesses and investors love U.S. Treasuries, so they're very happy to lend us that $2. That's fine. That's going to have to get covered at some point too, which is going to be covered by the taxpayers. So, you pay me now or you pay me later. If you borrow money, it's got to be paid back at some point.
Correct.
So that's the cost. In this particular case, the benefit when we flooded the economy with money, it seemed to hold the economy up. This is an argument that goes back and forth all the time between those who want to show a cost and a benefit. It did seem to help this government spending to help support the economy. I mean, COVID was a pretty big deal.
Right.
But the cost is this huge increase in spending and the resulting debt, which is going to be a drag on the economy going forward.
Continue watching on the next episode of the Stay in Your Lane podcast.